Hey guys, it's Dave, and by now you've probably heard that the Fed has raised interest rates by another 75 basis points in order to fight inflation, which is running at a 40-year high. This puts the federal funds rate in a range between 1.5 and 1.75%. The question is, how does this affect the housing market? And what can you do to put yourself in the best possible position to finally get into the home you've always wanted? To answer this, let's start by understanding the federal funds rate, okay? What it is and how it works. By law, banks must maintain a reserve equal to a certain percentage of their deposits in an account at the Federal Reserve banks to ensure they have enough money to cover depositors' withdrawals and other obligations. Any money in their reserve that exceeds the required level is available for lending to other banks that might have a shortfall in their reserve. The federal funds rate is actually the interest rate that one bank might charge another if this bank has lent out all of their money and they have to dip into their reserve. They have to borrow by law money from another bank in order to keep their reserve at that certain required level. So they borrow money from that other bank. Well, they have to pay an interest rate on that money on an overnight basis. That's what we call the federal funds rate. What is that interest rate that this bank has to pay this bank in order to borrow that bank's money in order to keep that reserve at the level required by law? That is the federal funds rate. So when that rate goes up, in this case by 75 basis points, this bank has to pay more money to borrow from that bank in order to keep their reserve requirement, right? Because they've lent out all their money. They don't know at the end of the day what it's going to be. They calculate it and say, okay, well, we've got to borrow $2 million in order to have our reserve requirement met. So we're going to go borrow that money, but they have to pay that Fed funds rate to the other bank in order to make sure that their reserves are in order. Trillions of dollars went into home loans during the pandemic when the Fed funds rate was zero because it didn't cost the banks anything to keep their reserves at the required level. They would just borrow from each other at 0%. Now, however, it costs them anywhere from 1.5 to 1.75% to borrow money from each other to keep their reserves at the required levels. Not only does this tighten the bank's ability to make loans, it requires that they make loans at higher interest rates in order to cover their own costs of borrowing. And as the interest rate on the 10-year Treasury bond moves up, mortgage rates also tend to rise. So what does this all mean for you if you're hoping to buy a house in the near future? Well, the bad news is the average interest rate on a 30-year fixed mortgage is now 6.2%. It's the highest level it's been since the 2008 financial crisis and up from 5.5% just a week ago. The 3.2 percentage point jump in mortgage rates over the past year also marks the biggest upward swing since 1981. And with the Fed expected to continue raising rates until inflation is under control, mortgages will only be getting more expensive. Let's look at an example. If a homebuyer took out a $400,000 mortgage in June of 2021 at the then average fixed rate of 3.1%, they'd owe $1,708 per month. At a 6.28% rate, that principal and interest payment comes out to $2,471. And that's assuming the home didn't change in value. Homes have gone up by an average of 20% this year, which means that the mortgage is now going to be $480,000. And at a 6.28% rate, that $480,000 principal and interest payment comes out to $2,965. That's quite a jump. The good news, however, is that because of this, demand for homes has softened and price appreciation has leveled off. Over the coming 12 months, Moody Analytics forecasts the year-over-year rate of home price growth to plummet from 20% to 0. Now, it doesn't necessarily mean that the housing market's going to crash, but demand will certainly ease up. And the other silver lining in all of this is that well-qualified buyers will have more of a chance at actually getting a house without having to compete with multiple offers and bidding wars. For what it's worth, this is the bottom line. If you're in the market to buy a house in the near future, I highly recommend that you do 3 things. Number 1, get your finances in order, okay? Know how much you can really afford. If you have any high interest rate credit card debt or revolving loans, anything that has an adjustable rate mortgage, you might want to pay those off as soon as possible. Number 2, work to get your credit score as high as possible. You can check out another video I did on credit right here. And number 3, start shopping for lenders. Not all banks or mortgage brokers are created equal, and it pays to shop around. Some lenders, they'll want to get your business by offering a lower interest rate than their competitors or discounting some of their mortgage closing costs. Plus, the more you can develop relationships and get all your pre-qualifications taken care of, the faster a lender can approve you when it's time for you to pull the trigger on buying a house. One last thing to consider. Historically, 30-year mortgage rates have averaged just under 8%. So even though today's rates have moved up, they're still a good deal comparatively speaking. Drop me a comment down below. Let me know what your plans are and where you think interest rates are going. And if you found value in this video, be sure to drop me a like on the way out. Go get them, guys. I'll see you soon.